Great to have you here with us. I'm curious, why boost your offer now, less than a week after your original offer?
Well, the company said that it was inadequate and that and that we didn't have the financing. So I just wanted to put that to rest. And you always have a little raise in these things anyway. So we just wanted to come in at 80. And we put up $5.5 billion, as you see in the letter, if you read it.
Right.
And as far as the financing goes, we put up another $1 billion in case there's a shortfall. So I think we put to rest the two things about the inadequacy and about the credibility.
Well, yeah.
So let me just break in, because I'm standing here in front of the Clorox Post on the New York Stock Exchange floor. They've only traded 1 million shares today, and it's not trading up to $80. It doesn't seem that investors are taking this offer as seriously as they might. I'm wondering why you think that is, Carl.
I think they're taking it pretty seriously because the stock has traded up quite a bit from the 67 or 68 that it was trading at when we made the first offer. So, it's trading below 80 because the company is still not said that they would put the company up for sale. And I will tell you that I think that this company does belong to the shareholders and that they should be given this opportunity because the Centennial Plan, I don't think is working that well. And therefore, in my mind, this is one of the problems in American corporations that are public, that a lot of boards don't understand that and CEOs that the company really belongs to the shareholders.
Carl, we did read your letters, the first and the second one, and the tenor seems to have changed. The rhetoric seems to be upped as well. You write in your letter today, you said, for Don Knaus and the rest of the board to claim our proposal remains inadequate and at the same time tout your record for shareholders seems a bit absurd. It seemed a lot more friendly that first go-round. What's kind of happened here?
Yeah, well, we read their first letter back, where they decided to take this approach of putting a pill in at 10%, which I think is reprehensible. And again, I do like Don Knaus. I met him, and we seem to get along all right. But I think he's, frankly, taking the wrong tack. The absurdity is that what does their past record really have to do with the fact that the shareholders should be given a right to take a 25 to 30% premium? The shareholders should have that right. I say in my letter, hey, what is the board risking? They have nothing, basically nothing to lose, and you read my little squib. I liked it. I said, the wars would come to an end if the generals and the statesmen had to be the first ones on the front line. It's similar here. If the board and the CEO had a lot of risk and a lot of money to lose, they might certainly take a different approach here.
Yeah, Carl, you point out that when Knaus came in, the stock was trading at 64 and change. Before you made your investment in December last year, it was lower by 3% at $63. They've lowered their fiscal 2011 guidance twice. They have a disappointing outlook for 2012. Why don't the shareholders say, I'd rather take $80 and run than deal with these guys who haven't done anything?
Well, that's my whole point. I think they would. I think they would, and I think they should be given that choice. And I just wanted to make sure they understood my bid is credible. I'm there to buy it. I've said before, also the shareholders might have a nicer choice because I really do believe that there are great synergies and there will be higher bids, but I'm not promising that. But I do believe there will be a better choice for them. But so the company is standing in the way of this.
Have you spoken, Carl, with senior management at any of these other competing companies? Do you hear that they are preparing bids or even looking?
I really can't speak to that. I'm not really. My lawyers would be really upset if I even talked about that. So I just will not say yes or no to that.
Hey, Carl, when you first came out, though, you were pushing or encouraging Clorox to go after some other offers. I mean, do you still anticipate that there are going to be other bidders come in, whether it's Procter & Gamble,
Look,
whether it's Kimberly-Clark? Are you still expecting that?
I believe this, that we've done a lot of homework on this, and the synergies in this are great for one of those kind of companies because they will save $600 million in synergies, we believe. And I don't even think the company will dispute that. Maybe by $100 million they might dispute it. So you save $600 million, which is huge. So a company would be able to go borrow money and pay. The interest you'd pay to buy this company would be made up just from the synergies. So these companies would be bringing a $950 million of cash flow to the bottom line just by the stroke of a pen.
Right.
And I think that's a pretty compelling thing. And look, I've done this all my life, but make no mistake, I'd be very happy to buy this because I think it's cheap at 80 for a buyer like myself. But I do think that the shareholders should be given the right to do this, because if I bought it, I've done quite well with a number of companies that we bought. In other words, every bid we've made, we've stood behind. I mean, and I sort of resent some PR guys say, we don't stand behind them. We always did. I mean, we can't help it if the company won't allow the bids to go out to the public.
Hey, Carl, if you did buy it in the end, I mean, what would you do with it? Because I think some folks think it's a bunch of a mixed match of brands. You've got Hidden Ranch dressing, Hidden Valley Ranch dressing. You've got Burt's Bees in there. You've got a mix of products. Would your goal be then to split it up?
We might do that. Yeah, I think that we might, if we buy it, we might split it up and possibly keep one of the divisions.
Which division?
I really don't want to go into that. I think it's premature. I haven't put it into a 13D, and nor do we have a real final solution on that.
What do you think fair value is, Carl? I mean, you say $80 is cheap. What do you think this company should be valued at? Well, look, we've said, so we're wearing two hats here, which is a little difficult. I'd like to buy the company, so every time I say it's worth more, they say, well, then you don't want to buy it. But we do. I mean, obviously, I think if I buy it at 80, it's a good deal for a private investor that can do things with it. I think the shareholders should really have that choice, because I think if the company just stands alone the way it is now, I do not think the company's stock will go higher. I do think, however, that what I just told you, the numbers are very compelling. If a large buyer came in and got those synergies, they could pay $100 a share and still make $900 million a year extra to their bottom line. So I do think that it's a great opportunity for one of them. Now, is there a guarantee anybody will come in? No. But there is a guarantee that I'll be there at $80 a share, if they give me due diligence.
Carl, let me ask you, because one thing people have been kicking around, too, is what about antitrust issues? If indeed a Procter & Gamble comes in, I mean, they owned it, back in the 50s and the 60s and had to sell it off because of antitrust concerns. Henkel, up to a few years ago, had about a 30% position of Clorox. I mean, they could have bought the whole company, but they didn't then. So what about antitrust concerns? Does that play into any of your thinking about it?
We've looked at it, and we don't think that would be a problem. But you know what? I can't speak to that. I'm not an antitrust lawyer, but I do think there are enough buyers out there that will not be a compelling problem.
Who do you think would be the best fit, Carl? I mean, Carol mentions Henkel and P&G. Unilever?
Now listen, I told you that there's 6 or 7 companies out there that would get those synergies without much trouble, and I think we listed them in my first letter. So I think the ones you mentioned, and a couple of others.
Hey, Carl, you've been kind enough to give us so much time. I have one more question for you. What if you don't? You say in this letter today, take it to the shareholders. Let's do that. What if you don't get shareholder support? What then?
Well, we've alluded to the fact that in the letter, as you notice, that we want to avoid a proxy fight. So you can intuit from that there, it doesn't take much to assume that there probably would be one. But I hope that doesn't happen, because if you see in the letter, a simple way out of it is go to the shareholders and find out what they want. Do they want to have the right to see this company put up for sale, and given that option? And you can avoid a proxy fight by listening to what the shareholders say, and both of us abide by it. If they say no, then I sort of walk away, obviously. If they say yes, I'm there, and I'm happy to buy it. I will put the $5.5 billion into escrow, as I said, and actually another $1 billion, and I would be there. And I really think that Don Knaus is sincere about what he says, that cares about his fiduciary obligations. He should do it, and it's easy for the lawyers to say, just say no, because they just get more fees. So it's an easy thing for them to do.
Hey, you guys still talking, you and Don Knaus, at this point?
Yeah, I called him last night pretty late, but it's earlier in California, to tell him that the letter was coming, and we had I believe, as he says, a respectful chat.
All right. Hey, you think this is going to, one last question now, I promise. Do you think this is going to wrap up, in the next couple of weeks or even sooner?
You really have to ask Don Knaus that question.
All right, we will do that. We will definitely do that. Carl Icahn, thank you so much. We really appreciate your time here. Thank you.
Okay, sure.
You take care now.